Really, when you're investing in large real estate assets, it's not so much about the investment side, but to think of it more as a conversion of your currency from just this dollar to this hard asset. I ended up buying my first apartment complex, October 2011. The first couple $100,000 I ever made in my life, I dumped into this deal. Probably the most stressful 9 months or so of my life, where it's a vacant property, everything's on the line. As a passive investor, especially in today's market, you can't 100% depend on sponsors to just, give you a good deal. Apparently, entrepreneurs don't do too well in corporate environments. You go out, you raise the money, you find the deal, you do the writing, get the loan closed, and that's usually where it ends. But the reality is, oftentimes that's just where it's beginning.
Hello, welcome to the Fundication Show. I'm Julie Tallman, and I'm with Christian Sadler.
Hey, everybody.
And today we have our brand new pre-iShare approved sponsor, our newest pre-iShare approved sponsor, Joseph Bramante. Welcome.
Hi, guys. Glad to be here.
Thank you so much for being here. He's with TriArc Real Estate Partners. He's the CEO and the founder and very well qualified to do all of that. We'll talk about that. But just thanks for being here in the studio, for flying in. And how's everything going at TriArc? Tell us a little bit about your team, how you came about. And I would personally love to know, with your civil engineering, your bachelor's in civil engineering, and then you had an MBA, how you then went to be a CCIM and now within TriArc.
Yeah, absolutely. So the CCM and TriArc thing happened kind of afterwards, but the transition was not intentional. I really never intended on going into multifamily. I was a very well-paid engineer at Exxon, and I planned on being a career guy. And apparently entrepreneurs don't do too well in corporate environments. And I had a, maybe attitude issue, or just talking out of turn and maybe correcting managers and having opinions that you're not supposed to have. And so that didn't really work so well for me in that environment. And luckily though, while I was there, I had started exploring other investment options just for like retirement, just like your investors are doing. I was doing the same. One of my managers, he was buying rental properties. These are like really crappy houses, like $60,000 houses, and he was renting them out. And so at the time, I'm living in Papua New Guinea. He was a rotator, so I was full-time. He would rotate every 4 weeks. So he would go home, he'd buy a house, he'd come back, he'd show us the photos, and he'd do it over and over again. And so, maybe a little bit of ego started eating up inside of me. So I wanted to do something. So I started researching and read a few books. And the books were saying that, single family is great, but if you have the money, just go straight to multifamily. And so started looking at apartments and ended up buying my first apartment complex, October 2011, a 26-unit apartment complex over at I-10 and Silber in Houston. That's a fantastic location. But then within the first 6 months, things kind of started going sideways. The first thing I would say actually had nothing to do with the deal. It had more to do with me being just busy. I was making too much money overseas. I was staying busy, and I didn't have the time to really focus on the property all the way. And it was it was a small check. It was a small property for us. It was me and another guy. And so we just didn't give it the attention it deserved. So I think that was kind of working in the background initially as well. But we took over this deal. We dropped 15% vacancy day one, which isn't hard to do on 26 units. That's 3 people. They had moved next door to a neighboring property. We're going along, and we're doing a renovation. So they move out, no problem. We'll renovate these units. So we renovate them, and we started that process with cash because we didn't know about bridge loans. And we start renovating the first couple of units. And then the next kind of blow was the insurance. So we found out that we didn't have insurance on the property. We purchased insurance, but apparently the broker who sold us insurance sold us fraudulent insurance, or he got scammed also. So they gave us a letter, and we made them sign an agreement that just said, we're going to get new insurance, but in the meantime, you're going to cover any claims you might have. We have a loss, it's on you because we didn't do anything wrong. And so we've solved that problem. And then we're progressing. We're probably like month 4 or 5, and we're about to install the AC system in these units, and you have to get a permit. And then when you get the permit, you got to do an environmental. And we hadn't done an environmental because the lender didn't require it. Your lender is actually your biggest advantage on a lot of these deals, because they require you to do all this stuff that if you don't know to do, you're not going to do. So we didn't know to do it. And our lender, this is 2011, I don't think multifamily was as mature of a market as it is today. And the lender that we were using, no joke, was Bank of Internet USA. Like, that was their name. It was like, oh, those are legit lender. And they gave us a loan. But anyway, so we get this environmental. It came back hot for asbestos. And oil and gas, I know the dangers. So we immediately stopped work, sent everybody home, told them that we're out of money and the project's over. And so now we're like freaking out because we got 4 units that are down like to the studs. We can't touch them. They got asbestos. What do we do? And then a few weeks later, that's when I get the notice from Exxon of being let go. So now I'm like, wow, what do I do here? Because now I've got a property that's negative cash flowing, and I just lost my cash. So I'm really screwed. Luckily, my partner was still working for overseas, and so at Exxon, so he was kind of helping us through this. But that was my introduction to multifamily. So yeah.
Yeah, and this is, I think, a common scenario for high income earners is they think, I need to get into real estate, I need to invest. And so they decide that they are going to go become the operator. Yeah. And oftentimes that's a very challenging situation if they're still working their day-to-day job, because typically those high income earners, it requires a lot of them. So whether they're corporate like you were in oil and gas, or they're a doctor or a dentist, they're already trying to manage the work-life balance, so to speak. Right. And then you throw a real estate project in the mix of that, and they think it's going to be passive because that's the way it's promoted, right? Is you buy a apartment complex because it's very passive. But you just illustrated how that can quickly become not a passive investment, and really probably wasn't from the get-go. So I'm curious to hear the ending of this story.
Yeah, so worked out well. Actually, we're signing the contract today to sell that property. We just finalized terms, so that's exciting. I've had it for over 10 years. But anyway, so to continue the story, the next day I joined a real estate group. And so I had this like 30,000 foot knowledge of just reading books. I had like 4 or 5 books I'd read, but they didn't give you that ground level knowledge. So I joined a real estate group. They gave me all the connections and contacts and the mentors I needed. Didn't necessarily help out that much because their advice was sell the property, take a loss. So I didn't really like that too well. The whole idea of losing money, especially the first like couple $100,000 I ever made in my life, I dumped into this deal. It's bad enough I'd lost my job, and now I was about to lose all the money I just made at that job. So I would have really been starting over with nothing. So that wasn't exactly an option for me. Luckily, though, I met my partners at that club. So I met them, and they said, you might have a chance here. Like, we were in a great location, so I did one thing right. Like the one thing that everybody knows about real estate: location, location, location. So I did that right, and we said, you know what? This is one of those problems where you can spin your way out of it. So we vacated the property. We got an asbestos abatement done, and we'd actually modified the abatement because people think asbestos and your natural instinct is to abate the whole thing, which would be incredibly expensive. So what we did was we just abated the wet areas. So any area that we may need to get to in the future that has plumbing behind it, et cetera, we abated. So we went in, we did that abatement. Well, first we vacated the property, did the abatement, did a renovation, and then we leased it back up. Now, as far as numbers go, it sounded pretty crazy at the time because we spent $25,000 on the purchase of the asset, but then $30,000 on the renovation. So we spent more on the rehab than the purchase, and I'm on my first deal. So people thought we were just way off our rocker. But I figured, if I'm going to go out, we're going out with a bang. So I'd cashed out the 401k. We got a bridge loan in place. We did all the work. And I have to tell you, that was probably the most stressful kind of 9 months or so of my life, where it's a vacant property, everything's on the line. Everything I'd read was just theory at that point, right? Like, people are telling you stories and you're reading case studies, but it never actually happened. But on paper, like, I knew it was supposed to work. And we just we went for it, and it worked out. We did a 207% cash out refinance 3 years later. So we bought it in 2011 and 2014. We're cashing out, doubled our money. Still in it today. We're about to double again on this sale. But that was kind of how I got the start. And then also through that, so met my two partners, Carrie and Deborah, on that transaction. And that was, we went to battle together on that deal. And I think when you've gone through deals like that and projects like that, you build a lot of trust. And they really showed kind of what they're made of and what they can do and their expertise. And I think that was kind of the beginnings of what is today TriArc.
Have you stuck with multifamily, or what's the TriArc portfolios looked like over the years?
It's all multifamily. I mean, we're doing a build to rent deal right now. If you want to say it's different, I think they're basically the same, but all multifamily residential. In the future, we've looked at some industrial. I think industrial is a very attractive asset class. We've looked at some truck yards and self-storage, but for now, I'd rather just, the caveat that we've done is instead of from multifamily, we've pivoted to development. We really like the development side of multifamily. Has a lot of advantages. It really helps. It's the only thing that helps the housing issue we have is just building and building and building. And we've owned a lot of really old apartment complexes. We don't want to own old apartment complexes anymore. We know all the challenges that come with it. I'd rather have the challenges that come with new development up front and then deal with and have a much easier operational time and easy exit than to go in and do the easy acquisition of an old property and then just not know, what skeleton behind the wall is going to come back and bite you.
Yeah, that makes sense. It's kind of choosing your battles and what type of challenges that you want to deal with.
Yeah.
I'm curious, knowing what you know now, and I love the fact that you got thrown into the deep end in all sense of the term, right? And you came out of it and you become a better operator because of it.
Yeah.
If you knew what you know now, and you were still working a job, earning a high income, and overseas a lot of the time, would you put money with another operator and just passively invest?
Yeah, if I could do it all over again, I think, to a point, yes, right? Like, I think once I got my portfolio to a certain size passively, then I probably would want to then start bringing some of it in-house. But I would want to grow it substantially. It'd be several thousand units that I would own. And then I think at that point, then you hire an operator, and then you're basically almost like a family office model. These are your assets. You've built up the wealth. And then at that point, I still wouldn't want to run it. I would still want to be passive. And I would just hire somebody to run that portfolio for me.
Yeah, that makes sense. And that's one of the things that I think we're trying to educate investors on is, where do you fit? If you're passionate about real estate, if you love the operations side, if you maybe have an engineering background and that analytical mind, it makes sense for you to be in there doing the operations. But if your passion is elsewhere and you just want to build your money and you know that real estate is a way to do it, it's good to look for solid operators that you can simply place your capital with and get returns. I'd love if you speak to that a little bit, because you give people the opportunity to invest with you. What is somebody looking at if they invest with you? What kind of percentage of the deal do they get to keep as a passive investor?
Yeah. So for us, we've transitioned away from doing individual assets. So now we're doing more funds. And I think anybody who's in deals now can certainly appreciate the benefits of being in a fund, right? So if you're in a deal right now and maybe it's not doing so well because you just bad luck, right? You just picked a bad deal that was great 18 months ago. It's not great now. And so for us, what we've done is we've transitioned to the fund model to give that diversity to our investors so they can be spread out across multiple deals. And we've structured it very, conservatively. So our model is an 80-20 model on our fund with a 1% management fee. And that's it.
Yeah, so that's solid. And that's kind of what I wanted to bring to light.
With a 10 pref on it. So we really keep it weighted for the investor. Is it below market? Absolutely. But the key with the fund is, especially for us doing our first fund, it's a $100 million fund, the key to doing your first fund is getting to your second fund. And so for us, that's how we view it. So we're going to give a reward to those investors who are going to go on this journey with us on this first fund. But But my mentors and others, I mean, they're typically charging 75-25 with a 9 pref and a 1.5 to 2% management fee. So it's, we're intentionally undercutting and trying to go cheaper. So that we can just get this first one done. But that's our typical structure.
I think an investor-centric model like that is really, it's so advantageous to somebody who's wanting to put their money to work. I mean, you think about that, for example, if they were your sole investor, they're getting 80% of the profit with a guaranteed 10% before you take anything off the table besides your management, right? You've got the 1% management. But essentially, you're saying, I'm going to give you 10%. There's a lot of people on the sidelines right now that have their money in bonds or, somewhere that's very safe, quote unquote, but they're making 5 or 6%. So they're making half of that. And you're giving them the opportunity to have that as a preferred return before you take anything. And they get to participate on the upside, right?
Right.
In a diversified fund with a very experienced operator.
And I wanted to comment another thing about just before that we were talking about, and I had a friend of mine who runs a wealth management company, and the way he explained real estate investing to me has really been a little bit different. In that, really, when you're investing in large real estate assets, it's not so much about the investment side, but to think of it more as a conversion of your currency from just this dollar to this hard asset. So, the asset's going to make money, it's going to do well, right? But it's more about you've just taken some cash out of the bank, which is, maybe you're over the FDIC limit, so now you've converted that to this hard asset, which is then protected, has all those, and it's going to continue to grow and has all the tax benefits that come along with it. But for those high income earners, right, like the best thing they can do is to continue to do what it is they're doing, to continue to bring in that high income and just focus on expanding that active income side while they're converting that excess cash into either hard assets or some other investment vehicles.
Oh, and the beautiful thing that you just mentioned, because FDIC only insures to a certain amount, you can insure a building to the total asset value. So it doesn't matter if it's a $100 million property, right. You can insure the total value of that.
Correct. I mean, even in 08, I mean, you look at the losses or the foreclosures that we had in 08, there was like 5% of the total population. It was incredibly small. And even now, like it's incredibly hard times right now, but nobody, I mean, you're seeing some foreclosures, but very minimal losses. So I don't think it's, by and large, it's an extremely low risk asset class. And especially for today, right now we're, relatively at the bottom. I mean, we're right at it or coming to it or right exiting it, however you want to look at it, but we are pretty close to the bottom. And so that means it's one of the safest times we're putting money into the asset class because we're going to, the cycle has reset. We're going to be going up for the next, hopefully 10 years before we have to worry about another cycle incident again.
Yeah. So we do have a plaque here for you that I want to present. But before we do, I'd love to understand the TriArc team. We've been introduced to you. I'd love to hear a little bit about your partners as well and how you all work together.
Yeah. So TriArc stands for 3. So obviously we got myself and my 2 partners, Carrie and Deborah. We were the original founding partners. Carrie started in property management in 1983 when her son was born as a leasing agent. And she worked her way all the way up to regional vice presidents and vice presidents for some really large companies. Lincoln Property Management Company was one of them. GFI was another. So she's been through many cycles. She's a very experienced lady. And then Deborah, my other partner, who happens to be Carrie's sister, started a year or so later. So Carrie dragged her younger sister into the industry, and same thing. But Deborah went more on the new construction lease-up side of the business, whereas Carrie did more of the workforce housing side. Together, they've done over 40,000 units of management over the years. And so that's very powerful. And that was part of the reason why we partnered together, because when I met them, I had a year of experience and I was failing. I wasn't doing so well. It was actually less than that. And so they brought in that reality of how this actually works. So there's that book knowledge that engineers are so good at, but then there's just the actual reality and the practical and the application of that knowledge. And so to learn from these two masters of how it works. And you can underwrite things all day long and it looks great on paper, but having them basically mentor me up and kind of build our underwriting model with them, as far as there's hours and hours of in their office, like, hey, like, I've noticed this relationship between these two things. Like, is that real, or how does that work out in reality? And then we'll sit down, we'll have a long conversation over it, because there's a lot of what's kind of in the book of how to do things, and there's the reality. And I think a lot of people don't transition and ask the property manager folks, like, hey, how does this actually happen in reality? Because it's very easy just to put some numbers on a piece of paper and use some standard underwriting stuff. But so anyway, we worked very closely together for the first several years. And then in 2020, we launched a construction company, TriArc Construction, and that's when we met our partner, Robert. So he was a gentleman who we'd known for the last 10 years prior. Carrie and Deborah knew him 2 years prior. He used to work in property management. He used to work for Carrie as a property manager. She was the regional, I believe, or something like that. But anyway, he had transitioned out of property management. I guess he figured out there was more money in construction. So he went the construction and launched several companies. And we were just over and over again using his company to do our renovations. And I said, hey, we have this relationship. You've continually beat all the bidders, and you do really good work. Why don't we look at doing something together? So then we launched TriArc Construction, partnered up with them. And then about a year later, that's when we added in our VP of Acquisitions, Jared Spain, who's not a partner per se, but he is on our leadership team, and he brings 15 years of experience. He worked for some really large companies. S2 Capital is one of them. They've got multi-billion-dollar portfolio, and he kind of runs the acquisition sides for us. So between those 4 individuals and myself, we're averaging around 24 years of experience, and we've owned or operated over 47,000 units. So that was the kind of the genesis of the company and the formation. And there's a little bit more details, but that's generally it.
Yeah, very cool. Well, I want to say from our team to yours, we want to present this plaque with you. You guys went through our full pre-iShare approval process and passed with flying colors. So really grateful to have you as a newly approved sponsor with pre-iShare.
Thank you so much.
Absolutely.
So Joseph, you've had so much great experience beginning in the corporate world, and you mentioned some of the cons of that. I know it's tough for an entrepreneur to go through the daily ins and outs of that, but talk about some of the benefits of that for us.
I love my experience at Exxon. It was a great company to work for, and entrepreneurship has gotten to be this really trendy thing over the last couple of years, and it is great, but I think people discredit the value that you get from working for a large company, because it's hard to kind of know how to build something or build a great company if you've never really been inside of a great company. And pros and cons, right? So I got the at least experience, like, what is it like to work for one of the largest oil and gas companies in the world that's been around for a long, long time. And you got to see execution and project management done at a level and at a scale that you seldom get to see done. And so learned a ton there. And one of the things I learned through that is just the importance of having a process for whatever you're doing. And at Exxon, we had, it's called MCAPS, the ExxonMobil Capital Project Management System. It doesn't all connect to the acronym. It's the most annoying thing ever, but it's called MCAPS. So anyway, that was their process on how we do all these massive multi-billion-dollar projects. And through that, we've kind of taken that and modified it, or really dumbed it down for the most part, and made our own version of that for multifamily. So we've got our own process internally that basically just identifies it gives us the roadmap for how we do everything from the exploration to exploring and finding these deals, to then once we've found the deal, kind of imagining what's possible and figuring out what the upside is here, to then going in and evaluating and doing that due diligence, to then executing on that that game plan, that business plan that we put together.
Is this that tried and true checklist that I've heard that you have, or is that something else?
That's something else. Yeah.
I wanna
So
get
this
to
is
that.
our E5 framework.
Okay.
And so it's 5 E's, right? So exploration, envision, evaluate, execute, and exit. And so it's our end-to-end process for how we take the properties and do all that. And it's important because a lot of people, everybody's got an acquisition checklist, right? It's pretty mundane. You go out, you raise the money, you find the deal, you do the writing, get the loan, close. And that's usually where it ends. But the reality is oftentimes that's just where it's beginning. And we've learned this firsthand, right? You get in and you trial and error, right? We've done deals where underwriting wasn't talking to operations, or things got changed last second, and then now you're trying to operate this deal, but the analyst made a change that's not even possible for the operating team to do. And then so now your operating team is frustrated, and then your investors are frustrated because they're looking at pro forma, and every investor expects that pro forma to come to reality. Like, it doesn't matter how many times you got to tell them, like, it can be 5 years later, they're going to hook up that pro forma, and they're going to want to know why year 5 doesn't match current year 5. And so thus the process was born. And for us, what it does is it forces alignment and it forces clarity of what we're doing. And so that way everybody on our team knows, everybody's signing off on it. It prevents any one person from making material changes. And so that when I ultimately sign off on it, I can see signatures from everybody else on the key documents that we now require at the certain stages of the process, so that I know that everybody on my team is signed off, and that whenever we go to close on this deal, that there's no confusion about what any number is or what the plan is or what the timeline is. It's all, everybody's clear.
I like that you have that SOP and the check off. It's like, I'm putting my initials on this section.
Correct. Everybody else is as well. Everybody signs off on it. So that way, if there's any question, we can say, well, no, you right here where you signed and you said this is what you can do. And it's also about accountability. And so when people have to sign on things, you tend to pay more attention.
Yeah, they take it more serious. And I think you hit, a very important topic that right now it's a little scary in the world of real estate in pretty much every sector, to where there's all this hype and people will teach you and train you how to go find a property. And sometimes they'll even tell you how to sell the property. But that operations side oftentimes is missing in a lot of these programs that are teaching people to get into real estate. And that's why we see a lot of operators that get in and then they have these expectations that I'm just going to hire the management out over here and I'm going to hire this piece out over there. But they haven't actually explored, can they get it done in the numbers that they're saying? And so you're saying, what you're basically telling us is you're going to the people who are going to be executing on that and having them sign their name and say, I'm going to commit that I'm willing to go and make these numbers work.
Correct.
And I think it all sounds good, and it's obvious that having that foolproof end-to-end process is so beneficial, but tell us why it helps de-risk the investment.
Yeah, so it helps de-risk the investment because you've got clarity on what's being done, and you've got alignment around who's all doing it and by when. I think a lot of times when you get into these deals from people who just throw numbers on a piece of paper and they go and they close on something, they don't take those next couple of steps of figure out, okay, well, how are you going to execute on that? Like, how are you going to make that come to reality? And so with us, one of our documents is, we've got this construction plan that is basically a scope, a schedule, and everything that's laying out after close, this is how it's all going to play out. And you got an operating plan of saying, okay, well, this is how that ties to the construction plan. The challenging part with our framework has been making it both detailed, where it needs to be detailed, but also not detailed where it doesn't need to be detailed. So like in the beginning, when you're looking at a lot of deals and the volume of deals that are going through the process is high, you're not going to have built out documents or everything. It's going to be a bullet. It's going to be something really minimal. And so figuring out how to get the correct amount of detail in it for the different stages of the process you're in was one of the challenges we had to figure out and overcome. But when we get to that point where we're signing on a contract, you've got a very substantial document that gets put together. And then when you take that next step, when actually closing on it, you got the finalized version of that, which is basically that is your Bible, right? This is how you're going to be closing on it. And so I can give this series of documents to any particular investor, and they can see from now until when we exit, this is how everything's going to go together, versus here's a investment package and a PowerPoint, and here's some random Excel files. It's not really thought together, So we actually make our team sit down and write out, how are you going to do this? And I think that's the how you get that de-risking, because it's easy just to put a PowerPoint slide together and put some graphics and do sources and uses and all the generic stuff that we're used to, but that's not a business plan, right? That's just somebody that's an analyst, usually that's working in Excel, oftentimes solo, putting numbers that sound good, and that's based on his general experience, but it's not really tied to the rest of the team. And I'd say that's the other part of it. It's not just the framework though, but having your vertical integration. We're seeing this very often. Most of the properties that are going back to the banks right now are all ones that were these very large co-GP syndications where you had multiple equity raisers all coming in. You had one guy doing this role and one guy doing that role. It's kind of like flag football on the weekends, They're just kind of doing their JV team to go do a deal, and there's not one kind of cohesive team or company that's moving forward with one mission and one goal. And so I'll say that's the other thing that de-risks things a lot, is when you've got that kind of universal accountability, like this is TriArc or this is whoever the company is, versus this is our conglomerate.
Well, and I know that you've got that in place, and you also have a checklist that Julie had mentioned for analyzing deals, right? And it's like a 20-point checklist, so I'm sure people could find that on your website. But maybe pull out some of those key points that you think people should understand when they're trying to analyze a multifamily deal, whether they're going to go buy for themselves or maybe they're analyzing a sponsor's deal. What are some of those key things that they need to look at?
Yeah. So we created this passive investor checklist about a year ago, and it kind of came out of the passive investor conference that we're hosting for the last couple of years. But the genesis of it is that, really you can, as a passive investor, especially in today's market, you can't 100% depend on sponsors to just, give you a good deal, right? There's so many sponsors out there. They're of various quality levels. And so unfortunately, as a passive, there is some active work that you have to do in the beginning. You've got to do some due diligence. And I think that's where investors get confused. They say, oh, it's passive, and I see a deal, and what they tell me is true, and it's going to work out, and I just put my money in, and I get this result. And I think people are finally realizing that's not the case. And so as a passive, you've got to go and you've got to kind of do your own due diligence. And so we've created this 20-point checklist where they can kind of go through and check the box, and that would get them at least to flesh out about 80% of the deals, so they can focus on the 20% that they really want to kind of do a deeper dive on. So I'd say that one of the first ones was kind of what I was talking about just now, about experience and the syndication model. So are they vertically integrated? Do they have everything in-house, or are they a kind of conglomeration of general partners? And not that there's anything wrong with that. I'm just saying there's going to be more risk when you go through that kind of model versus when you go to a model where it's all in-house. How much experience do they have? Do they have at least 5 years of experience? I think the 5-year mark is important for a couple of reasons. One, they say most people go out of business in 5 years. So if they're still around for 5 years, that's good. 2, it takes 10,000 hours to master anything. If you're working full time, that's 2,000 hours a year times 5 years. That's 10,000 hours. So they would have been a master at that point, hopefully. And 3, most deals exit every 5 years. So now you've got at least a track record you could look at of you've exited some deals. How did you do? So I think that 5-year mark is really important. One of my pet peeves is this economic vacancy term that people throw out. You see it on underwriting models all the time. It should not be anywhere on a model. Basically, it's when they combine bad debt, loss to lease, concessions, and vacancy together, and just smash all together in one line item, and it's maybe like 15% or 20%, whatever it is. But there's no reason for it, and it drives me crazy when they do it. And it paints way too broad. It paints way too broad brush of an analysis on deals, which maybe you could have gotten away with 5 years ago, maybe especially 10 years ago, maybe 5 years ago. But in today's market where everybody's underwriting to the limit, you really can't do broad strokes anymore. I like to think of it as the analogy of, like, imagine you're driving a car and the only instrument you've got is your speedometer. Like, speedometer is important, but you should have an RPM gauge. You should have how much fuel you have and all those things. So if you just combine all that, it's not really that beneficial. So definitely you don't want to see that kind of vacancy. If you see that on deals, ask them to break it out. And when they break it out, then you can start to see like, oh, maybe this doesn't make sense. Because I've seen deals where they break it out and it's like, oh, well, you're assuming no concessions and very low loss to lease. And so it kind of, when they combine it, it kind of buries and hides some of the assumptions, which as a passive, you want to know what those assumptions are.
This is actually kind of brings me back to when I was helping a lot of people do fix and flips, for example, and we had all these formulas to get the initial offer out, right? Sometimes it's important because you're making offers on everything until you get some negotiation, and then you get into it. But I would find people that were closing on a deal and they had never actually ran the final numbers, and so they might be forgetting one or two costs in that deal and thinking they were going to make money, and they were really set to lose money. And hopefully we talk to them before they close, because if you do it after you close and you don't have a true breakdown of every single cost, that can make or break the whole deal, including for the passive investor.
Absolutely. I would say another one, this is kind of relevant today, is you want to look at a going in cap rate that's greater than your all in rate. So whatever hopefully they have fixed rate debt, but whatever their rate is, you want the cap rate to be higher on a stabilized deal. Right now, if it's a big value add deal, you can compress the cap rate to be lower than that, but you want to know that the stabilized cap rate is then higher. So whatever the increased NOI goes to, that creates a cap rate on a stabilized basis that's higher than whatever the whatever the all-in rate is. And that's just going to help you with your cash flow and liquidity. But those are simple checks to look at. And then the last one I'll leave you with is on the exit cap. So we talked going in cap, now on exit cap. Traditionally, it's been 0.15 bips or 0.15% increase per year. Sometimes you can go aggressive and go 0.1, or you can go conservative and go 0.2. But generally, it's how much you're escalating, so that if you held a deal for 5 years, then you should be, if you bought it at a 4% cap rate, then you should be looking at either a 4.75 or a 5% exit cap on deals. And a lot of times you weren't seeing that. Now, obviously, nobody saw what we recently experienced with cap rates going up as high as they have in this short period of time. So that metric would have worked, but these are really kind of rules of thumb for normal, healthy markets, not for these kind of unusual times we're in.
Yeah. So I know that obviously some of these end up being some hard conversations, and you're the one that's willing to have those. How do you communicate with your LPs throughout this process?
Yeah, so it's tough to communicate because things are pretty fluid when you're doing these negotiations, right? Like, so one day it's this, the next day it's that. You also don't want to scare your LPs because it sounds really scary, and it is really scary, right? It's really high stakes stuff we're talking about. We're having hard conversations. You're having to do negotiating stuff to bring people to the table that maybe they send you a nasty email and it sounds very threatening and alarming, and you just got to be calm and get them on the phone and talk through things and not take the first reaction as a reality. Usually it's just a knee-jerk reaction. But yeah, if you were to communicate to investors too much during these things, I think it could be bad. And so for us, we try to do it just on a monthly basis, or anytime they reach out, we just give them a quick update. But we try to keep it monthly because that's when we have more meaningful stuff to share.
How do you do reporting? Is it kind of paragraph, like essay on what's happening? Is it numbers? Is it What
For
does that
stuff
look
like
like?
this, it would just be kind of bullet points like, hey guys, this quick update on this, and this. All right, I'll let you guys know when we have a better update. Or if it's a bigger update, we do the same thing, but we do a short version and a long version. So here's a short version, a paragraph. Here's a long version, it's 5 paragraphs. So that way, if you're a details kind of investor and you want to know every little thing, it's there. If you just want like, hey, just tell me the high points, it's there.
That's smart because every sponsor does it. Every syndicator and sponsor does it differently.
Yeah.
And I like that you give them those 2 options.
And it's really easy because with ChatGPT as a syndicator, like if you're not using that, I'm writing the long version and I'm running and I'm editing it and then I'm saying make a short version and it makes a short version. It takes 2 seconds now to do that. It's basically Excel for words, which as an engineer I love, and so it's really streamlined the communication, and it's also allowed us to just like word vomit into GPT, like this is what happened, and make it sound intelligent and coherent and flowing so that investors can get what they need and not require hours and hours of review, edit, because that's, wordsmithing takes forever.
Yeah.
Yeah.
I'm curious. So oftentimes we find that sponsors attract investors that are similar to them. How do you find your investors? And do you find yourself oftentimes dealing with passive investors that have more of an engineer analytical mind? Or do you find that you have a different investor base?
Yeah. I do find we have more engineers or professional investors or oil and gas professional investors. And it's always fun. The engineers are either 2 types with me. They're either I never hear from them and they're just quiet, or they're the challenging type, or not the engineer challenging type, which we don't really think about it too much because that's just how we talk. We just talk kind of direct in numbers. And I think if you're not an engineer, you might take it the wrong way. I've got another engineer that works for us, and just remind me, sometimes we've had conversations and meetings where I've had to check with him after. I'm like, hey, Matt, is everything okay? Or like, are you just talking engineer with me? Because like I sensed it was just engineer, but I also just wanted to follow up with you to make sure that there's not some underlying like tension for something. And he's like, oh, no, we're good. Just engineer speak. It's like, good. That's what I thought. But for the rest of people in the audience, in the room, they may not have thought that. So it's just how engineers talk sometimes. But yeah, a lot of my investors do tend to be engineers, oil and gas related. And now we're kind of transitioning. We're getting some institutional guys and some family office folks. But yeah, that was the genesis. So a lot of Exxon in the beginning, and now not so much Exxon, just because I don't have that same Rolodex anymore.
Branching out. Yeah. Tell us about your Passive Investor Conference. You're the host of the Passive Investor Conference. We found out about it because Christian recently presented for you, but how often do you do that? Who is it for? What do you cover? Tell us all about it.
So it's an annual conference that we host virtually, strictly for passive investors. And the goal is to get them exposure, one, to kind of underwriting techniques. So we kind of spend a half day or so just like breaking down the profit and loss for passive investors. So like after they've gone through that 20-point checklist, so maybe this is one of the deals that they really liked, now they might kind of go through that P&L and look at how the underwriting was done and then break it down. And so we have a detailed presentation on that, but then we also have exposure to a broad sector of passive investing options, from manufactured housing, self-storage, industrial, private equities like businesses, the full gambit. Because we really just want to give people exposure to other stuff besides just multifamily, because that's one of the beauties of a passive investor, is that you don't just have to do multifamily. You can do whatever you want. You can do Airbnb or self-storage or whatever is of interest to you. And so I think we recognize that, and we wanted to kind of get them that exposure, because a lot of times it's not there. Usually it's like you go to a multifamily conference, or you go to a conference on self-storage, or you go to a conference on this. And all of the presenters there had been prepped so that, the context when I'm interviewing presenters, the basic pitch is, I want you to, assume that me and you are best friends, and I'm looking at a deal in your area of expertise. What should I know about this type of investing? I want that in their presentation. And that's how they present it. It's not a pitch. I don't want you to sell anything. We're not trying to do a deal. I just want you to educate on how to break down deals in your sector. Like what's special, what's unique about deals in industrial that an investor should know about that's maybe not going to be in that presentation.
To identify.
Yeah.
How much of you having that CCIM designation do you think played into you creating this passive investor conference? Because I think some of the best training I've received or seen has been from people that are CCIMs.
Yeah, I mean, CCM is definitely the gold standard. I mean, they do a really good job. I would like to see them do a more multifamily focused curriculum because it's very broad, but they do cover it well. But I wouldn't say it's influenced the Passive Investor Conference too much. But what it has allowed me is to get some of the speakers are CCIM. So I've got one of the guys who does the how to pick a market, which is another thing I think for passives is really great, right? Like they can invest anywhere they want in the country. They don't have any issues. For me, I can also invest, but I wouldn't be as good. Like for us, our specialty is Houston or based in Houston. All of our experiences in Houston. Anytime we go outside of Houston, it creates risk. And I think any good operator would recognize that, and they should really, you want to specialize as an operator and really go hyper focus. But as an LP, you don't necessarily want to. You want to be a generalist, and you want to invest with the folks who are specialized. But you can read an article in the paper and like, oh, you know what? I like Salt Lake. I want to come invest in Salt Lake. And I can't necessarily do that because for me to go invest here would be I'd have to buy a whole portfolio and it'd be a big deal. So anyway, he was one of those speakers and he teaches a whole curriculum on that. But I think CCM in general, though, I do like their format. I think doing it virtually was definitely useful to see, like, you can teach stuff virtually. You don't need to be in the classroom. I admit, though, you do get more knowledge from it being live and in person, or it just feels like a better connection. But also what I've discovered, and the reason why we don't have it live, is because passive investors are just doing this as an investment, like it's a hobby, like they don't want to spend hundreds of dollars to come in to a live conference and fly and get a hotel and all that stuff. They are looking for like kind of minimal check to just get that knowledge. And they're probably busy. They may watch it live, or they're probably going to watch the recording at their own leisure. And so that's why we created it virtually, so they can tune in whenever time fits them at a price point that works for everybody. Because I don't want to, have to host a, venue, and it gets very expensive and all that. So we're looking for a nice, easy thing to do.
I love that you do it that way. Do you do it quarterly? Or is it yearly?
Yearly.
Okay.
We're trying to do it biannually, but then we might try again to get going again, but I just got busy. So
So fall of 2024-ish?
Yeah, fall of this year, we're looking at doing it again.
Yeah, and you're right. I mean, when you're focused on your other business running a big event, even if it's virtual, I mean, you have a tremendous amount of speakers that come through there. There's a lot of organization that comes into that.
Yeah, we had 40 speakers the last one. So a ton of speakers. And yes, coordinating that is a nightmare. And then you're always dealing with the handful that just drop out. Something happens last minute, you're fixing it. So it's, it's fun.
Now, I'd love to turn the conversation to a little bit about what we do, because you understand the world of real estate syndication. You know that LPs for a really long time now have had virtually no liquidity. And what liquidity they do have, they're going to their sponsor, who is oftentimes onto their next raise. What do you think it's going to mean for the marketplace when we have a wide adoption of this secondary sales of LP interests, where people can buy and sell and have more liquidity within those investments?
I think, imagining a future where that's already built out, where that's already kind of the standard, and people are just going to this platform to either find new deals or find deals for shares they can buy from somebody else who's already in a deal. Honestly, I think that you'll have, being able to buy shares from somebody that's in a deal that has years of track record that's been running is a much lower risk bet and investment than going into a deal that you don't know. Like, you got a pro forma and they can have the best processes in the world, right? And there's still that unknown factor of reality. And so I think that would certainly create. I think it gets interesting though on how often they might be trading their shares. Like if it's a 5-year deal, people are trying to exit every 2 years and they're happy to take that initial run up. So they'll take the initial risk and they can exit out their money. And so maybe if the deal would have made a 2.0, they're happy with a 1.5 because they just took the first, 50% of the risk, that initial risk. They're the highest risk initial capital. And the new investor coming in is the lowest risk capital because it's already running. I think it'll get interesting to see how they get priced, because I think that's a component of it. Obviously, you get the valuation, but there's also who took the greater risk, the guy going in initially or the guy who's exiting out. But I also think it'll create more interest, because now if like if an emergency happens and you have to, my car actually almost caught on fire last week. I have a classic Porsche 87, and sidebar here, they're known for catching on fire. Had the AC condenser in the front, the tools had slid forward, and by luck, I happened to be in the gas station. I was cleaning the windshield and I smelled smoke, and I popped the hood and there was like a mini fire going on inside the hood, the bonnet of my Porsche. And because it had gotten hot and started to spark, and I had my car cover in there, and it caught the car cover on fire. So I pulled it all out, put the fire out, unplugged the thing. But that could have been very bad. And that could have been a situation where I might have wanted to sell some of my shares in a deal to take care of that car. I mean, it's got insurance, so it would have been fine. But I mean, just saying, stuff like that.
A true life emergency.
A true life emergency, right? Stuff like that happens. So I think that's one of the bigger reasons why people don't go into these longer term assets, because they're like, 5 years is a long time. That's a college degree. I don't want my money be stuck. What if something happens, particularly on kind of newer investors? So I think that'll create a wave of newer equity coming to the market that now sees an option to get out if something happens, or maybe they have another investor they want to go to and they're happy just kind of taking, some profit, but not all the profit from that first investment. Because the other thing that happens is there's all that FOMO, right? That fear of missing out. Like, this deal is great, but man, and what happens if I see a better deal? And so people will sit on the sideline forever waiting for that better deal, and it never comes. But now you have the option where it's like, okay, we'll just sit here. And then if that better deal comes, and sell your shares and go into that better deal, and you can get uplift on your initial investment. So you got more to go into the future deal. So I think those two scenarios will play into it well. But I think it gets interesting, right? I think it's complicated too, because figuring out how. I mean, that's for you guys to figure out. But like, what is it worth, right? How do we do this? And I think that's the other thing. Stock market, it's an efficient market. It's mark to market every day. Private equity is not, right? It is.
Get it to that point.
Yeah. How you figure out what it is.
Can we talk about it from a sponsor's point of view? Because we'll have people that'll say, well, I would love to sell my shares, but I'm actually a little nervous to talk to my sponsor. Are they going to be mad that I want to sell? Are they going to? So from your point of view, knowing that that's what's in the works, what's your knee-jerk reaction on what it means for you and TriArc? For me, it really just depends on the size of the investor, right? Like, if they're less than 20%, I don't really care. Like, why would I care? If somebody's out of the deal, I think I would be making money, I believe, right? If they sold and they make profit, then I'm getting some promote on that. So then why would I care? I'm sure, sell your shares. I'm happy to take some profit. But if it starts getting to be more than that, right, then it's where issues where you got to disclose to the lender, and it gets a little bit complicated. Or if it becomes material ownership, where it's like, hey, now if this guy was over 50% of the deal, and I bring in some new guy who I don't know, but I think those are probably extremely rare situations. So that's probably not the base case. So other than that, if they're less than 20, I could care less. Have you ever been looking at your next deal or building something and then had somebody come to you and said, hey, I really need to cash out. What can you do for me? And have you had that happen?
Yeah, we've had, and what we've done in those situations is we've reached out to our existing investors, like, hey guys, I'm actually doing one right now. There's an investor who, and it's interesting. It's interesting to watch them negotiate. I'm just copying an email, and I'm just there as a guy who's copying an email, watching them negotiate the value, and I chime in where they ask me like specifics, like projections, what it's worth, but I keep it strictly factual. Because I don't want the guy to sell. Because for me, it's like, why this guy's selling some shares, and because he wants the money, he's gonna take a loss. And I'm like, oh, why are you doing that? Like, just the deal is anyway. But the other guy's getting a good deal because he's getting in for below the guy's basis, and he's getting the pref that was accumulated on those shares. He's getting that as well. So I think that's their only mechanism right now. Is otherwise, if nobody wanted to buy his shares, then there's nothing I can do for him.
Yeah. And I mean, there's a lot to unpack on everything that you just went over. And I'd love to dive a little bit deeper into some of that, because when it comes down to it, first of all, you as a sponsor have to sign off on any sale, right? And so there's the kind of the protection that way of, if somebody is a large partner and they're going to try to sell a large amount, you still have to approve that, right? And you're still going to do your checks to make sure that if this is a 506c, that this is an accredited investor, and, do those double checks. But what we found from some of our top sponsors is they say about 7 out of 10 investors that want to invest with them don't, simply because of the lack of liquidity, because they aren't sure what's going to happen over a 5-year horizon, like you're saying. And so having that liquidity factor, if you even get half of those, or a third of those for that matter, that decide to invest rather than wait or put their money into a lower performing asset that gives them more liquidity, then there's more investors in the market, which naturally you would think that would also mean the price of equity may come down. And then you also brought up a really good point, is if somebody's good at finding good sponsors or getting into deals early and they're willing to take that upfront risk, they may be able to reap some of the rewards and leave some meat on the bone for this secondary investor, who I think that there will be a bigger portion there as well of the more conservative investor, like you said, that they can actually look at how it's been run so far, what the market's been doing, what the projections are. If you're 2.5 years into a deal that's set for a sell in 5 years, now all of a sudden you can see a little bit more clearly the horizon. We still can't predict anything, right? But it just brings in all of these different levels of investors that give them more opportunities.
Yeah, because to that scenario, right, the problem is when you're buying deals, there's an understood kind of gray area that sellers play with the financials, and that it just is what it is. They can get really creative and what's below the line and what's not below the line, and you only see the above the line stuff. And so going into these deals that have been running for a while, no sponsor they're going to give you the reality of what the true financials are, right? That gamemanship is done with. That's the risk that the first investor took with you. So I think, to your point, it definitely will create a market for that more conservative investor who's coming in, has years of financials, not just for the deal, but also the operator. They can see, hey, how'd the operator do? How's the reporting been? How's everything been? Is it what they've claimed? And now they can come in and they can ride out the last couple of years.
Yeah, I just want to point out to the audience that one reason that we do pre-iShare, pre-approved sponsors is just that. Every investor should look at the deal, but if they're if they're looking to invest in a TriArc deal or another pre-iShare approved sponsors deal, they can rest somewhat easy knowing that we have vetted them thoroughly. We looked into so many of your numbers going so far back that it's like, for every deal, you have to vet the sponsor and the deal. With you and our other pre-approved sponsors, that majority of that work's already been done.
And I do think it's going to be interesting to see how the pricing comes about. We're not going to set pricing, we are simply the marketplace. And so I think that there's going to be those scenarios where it is going to determine a lot on the need, right? If somebody just needs out of a deal because they're going through a divorce, or, their car catches on fire, as you mentioned, or kid gets into college early and now they've got to, fork out the bill for the Ivy League, those people might be more motivated and they may be willing to put it out there and take a lower price up front. But, you brought up something as you were talking of, if this has been established for a certain period of time and it becomes a lot more efficient, there will probably be a pretty standardized, pricing model, within that. You could still probably get in and get good deals, but at least you'll have some understanding of what things have been selling for that are providing similar returns with, similar sponsors and similar asset classes. And at that point, it may be as simple as, I know I can get this much on the secondary market and put it up for sale.
Two things kind of popped in my mind when we were talking about that. One was sponsors' approval of that, because they are getting some promote, right? And if they would the sponsor approve a deal where there's no promote to him or her on that transaction? So I don't know. I wouldn't care personally, but I mean, for me, any promote would be a cool kicker. But you're not like, why would you hold back an investor like that? This seems wrong ethically. But the other thing I thought of was, man, like if you're a larger investor, and if you're just sitting on cash, and you can come into deals and it's opportunity, right? Somebody's divorced, they need the cash. They're looking to exit. So now you can buy up all these shares on well-performing deals at below market pricing, taking advantage of somebody's unfortune. And that's just, the reality. And you could, that's what I would be looking to do, because that's how you make the money.
But even if it is a win-win,
Yeah.
Even if you can pad both sides just a little bit, leave enough meat on both sides of the bone, just having that performance is.
Yeah. You're going to have all those scenarios, right? You're going to have all the where it's a win-win. You're going to have some where it's opportunity is going to be opportunistic, and you're going to have some where, I don't know, I think the sponsor might have some. I'll be curious to see how it plays out on sponsors, but I think obviously you're using only approved sponsors and they're all going to be good people. I'm just, some of the shenanigans I've seen out in the market with some folks, I'm just thinking might act differently, but they're also probably not going to be approved sponsors.
And we've been lucky enough that, so far 100% of the sponsors that we've talked to about being able to sell, from their deals are totally open to it. I think that at some point there's, the little bit of fear is, is this going to make my investment look bad? Yeah. The reality is, I think anyways, is if you're taking an investor that doesn't want to be in your deal for one reason or another, and you're putting in somebody that does want to be in your deal, there's like no downside to that.
There's two sides to that coin from the sponsor side, and neither side I think you should do. And I've seen this. There's a large sponsor in Houston. I'm not going to name any names, but his track record, he's got like 30 properties, and half of those properties, the track record he states is the individual performance that a handful of LPs got when they sold their shares individually. So not the performance of the deal, but these were very well cherry-picked guys where like they just, I don't know how the transaction came to be, but somebody sold for above market on the share, and that became the value, that became the return metric for the deal, even though the deals are still owned. But anyway, the point is, in neither case, either whether you sell for a windfall on that particular transaction or you sell for a loss or anywhere in between, I don't think that you should count towards the deal metrics, because it has nothing to do with the sponsor in the deal. That was an individual investor making a decision on his shares, on what the value was, and nothing to do with your approval.
And I would have to agree. It's separate, right? Yeah. Secondaries are kind of a separate evaluation, because you're going to have some smart folks that use this model and say, I can get in with this operator and get a preferential treatment because I'm getting in early and I'm committing a certain amount of money. And then I'm going to let them do their value add over the next couple of years. Yeah. And then I'm not going to wait for the exit. I'm going to turn around and sell it to somebody else who's more conservative of an investor. And then I'm going to redeploy that money into either the next deal with that sponsor or a different sponsor that's doing the same thing. Because in real estate, I think oftentimes, especially multifamily and commercial, your big bump in value comes in the early years. And then you don't realize that until the end of the deal.
Right. Question for you. How are you guys seeing pref handled on these deals? So say you're in a 5-year deal, somebody's been in it for 2 years, say they had $100,000 in shares, they've accumulated, let's say it's 10 pref for easy math. So now they got $20,000 of pref that's been accumulated, and let's assume no distributions. If they want to exit that deal, what do you think? Like, how do y'all see like the new person assuming that pref, or is that all baked into the final equation, or like what do you see?
Yeah, I mean, ultimately that should be, because really when you buy into a deal, you're getting a percentage of ownership, right? Or you're getting a certain amount of shares. So those shares are accumulating that pref regardless. Right. And so it's a great question. And this is where, again, as somebody's evaluating these, and this is one of the things I'll be talking about at a conference coming up, is how to evaluate secondaries, is you do have to give value to that pref that's been accumulating, even if it hasn't been realized yet, right, because there's value to it. Now, it may not be the total value of what's accumulated there because it is in unrealized gain. And so, that comes down to the buyer of those shares. How are they going to calculate that? And I guess you bring up a point, is it should probably be, defined in that with the sponsor as well, and make sure that sponsor, agrees that pref comes with those shares and is going to be paid accordingly.
Yeah. Yeah, it's interesting because we're having that same discussion on this one investor of shares I mentioned we're selling, and the guy's just getting them all. Like, he's getting an awesome deal, and I'm just like, or the buyer's getting a great deal. The seller, I'm like, what are you doing? Yeah. But anyway.
And we've seen some of those, I had a friend, and, they were set for a refinance within 7 months, but the investor just couldn't wait, didn't want to wait. And she did not care that she was going to lose on all of the potential gain that was there, and that she would be getting, she would most likely be getting all of her money back within the refinance. For her, it was just a need. She just wanted to get rid of it.
Well, it'll be interesting to see how it all plays out. I think it's, I've been waiting for this to come, and you would think that this would have been here already, but it's just not. But it's one of those things that's so obvious. Like, why aren't people doing this already? It's stated right there in most of our LP agreements that you can do this, but yet nobody exercises their right to do it. So I think it'll be interesting as it builds out and as it gets more momentum to see where this goes.
I've been blown away by it as well, that there hasn't been something before. So I feel really lucky to be brought into this team. Curious, is there any final advice that you would give to either somebody wanting to become a sponsor or somebody that's wanting to become a passive investor when it comes to multifamily real estate?
Put your last 20, 30 years into a nice little nugget for us.
I know we're talking about exiting shares and all that, but I think it really is a long game. We talked earlier about, earlier I was having a conversation with another gentleman about investment size, and so I think multifamily is a kind of a longer term play for large investments. I think people get into a bind when they try and do small investments in multifamily, and then they try and exit earlier. So my advice to people is, like, if you've only got 25, 50, maybe even 75K, maybe do not do multifamily. I think multifamily is really geared more towards larger investors, minimum of 100,000, and really gets more interesting over 250 and 300, because people are really in this for the cash flow. Like, that's what they want. And if you want cash flow, okay, well then if you're trying to get $100,000 a year in revenue, you're looking at $1.5 million of investment. You're not going to get there by making $50,000 investments. So I think people jump straight to the cash flow too fast, and they need to focus back on the capital appreciation side first. And how do you grow that capital to a point where it's now big enough to then get you the cash flow you want on these longer term, more stabilized deals? So that would be the advice I give to passive investors looking at doing multifamily, is just to acknowledge the returns that are what this asset class is really intended for, and to also just be aware of like the kind of returns you can get in other areas. Like, single family will beat the socks off of multifamily any day. You can do a flip in 12 months and make a 30 or 40% profit all day long. At least in Houston you can. Those numbers are pretty common. But I think people, they see our multifamily deals and say, oh, 2x return, but they don't realize like, well, that's 5 years, and that's maybe 2x, and if it's 1.5x, you just sat for 5 years in a deal with $25,000 or $50,000 that you could have put into a house, and you could have, if you would have done that over and over again, you would have had 2-3x return in the same period of time. So I think that would be the advice, is understanding where your money is best suited for the investment you're making.
And that comes down to, many times the passive investor are the high income earners. So they have somewhere else that money's coming in. If you're not in that high earning standpoint, you got to figure out how to become a high earner so you can truly become a passive investor. And sometimes that means you become an active investor up front. So like you said, you're out there doing fix and flips, or you're doing, wholesaling, or something that very little capital can get you bigger returns until you get at least enough of a nest egg. And hopefully, if you can get to the point where you can reach that accredited investor status, now you can get in access to deals that the government wouldn't allow you to participate in otherwise.
Yeah, but you can do fix and flips passively. Like there are guys, and we've done some on the side for people. We're selling a house right now. That was one of our flips. Like I do fix and flip on the side. My partner does. I just give him money, and we give some investors. We'll throw money at him, and he'll go do a house or something for us. And that's my play money, right? That's just our fun money to go and you do stuff with. But I think there's, you don't need to be active to do stuff like that. You can go to real estate groups or meetups, and you'll find people that are flipping houses that have a track record or whatever. There's other investment types, but I think you just always got to be aware of the size of the investment for the asset you're doing. And that's why, multifamily is great for that side as well, because if you had $1 million, you couldn't realistically deploy that into houses as the average person, right? You would have to build out a whole company and all that. It'd be a lot of work. But you could very easily put that into a single multifamily deal. And I think that's where it makes sense. So I always think of it like your big money and your small money, right? So my small money plays around houses and does stuff on the side, and I do vacations and all that. But my bigger money goes into multifamily deals.
So did you say that entry threshold for you into multifamily is right around 100,000 and above?
Right, 100,000 above. Really more if you can, but that's generally where you want to be. And to your point earlier about high income earners, like I get it, right? Because it's even harder. The whole goal of passive income is to exit the rat race, and to exit the rat race means that your passive income has to be greater than your expenses. But when you're a high income earner, your expenses are generally just as high. And so coming from that world, it took me, even as an active investor, it took me over 5 years to replace my Exxon salary. Like it was tough. And so I think if you're a passive and you're in one of those roles and you think like, oh, I'm just going to do this, like even as an active investor, it's going to take you a long time to replace that income. So you'd be better off, I would say, sticking to the passive side and just maybe doing it 10 years. And after 10 years, once you've got your whole portfolio up, then you can look at consolidating, doing a family office, doing whatever. But it gets really interesting, right? When you play around with it and you model out, I do this thing called the Passive Investor Roadmap, where we sit down with investors and we'll build out a 10-year plan for them. And we say, okay, you got this much money now. Basically, they tell me their balance sheet, look at how much capital you have right now and how much investable capital you have every year. And we've come up with a roadmap of how we would deploy that into what different asset types, and then which types within that asset. So multifamily, but is this a value add, or is this a big multifamily, or is this a small multifamily? Or sorry, is your investment a large or a small investment? Because it has different benefits if you're a larger or smaller investor. But we map the whole thing out, and it's really fun to do that with them and to watch the light bulb go off and to see as the deals start exiting in years 3, 4, and 5, and then they're reinvesting their active on top of their new gains, and then to see that cash flow pick up.
Got that spreadsheeted out so they can kind of see final numbers.
Yeah, it's a special moment for me. We get to do it with investors, and you see their eyes get big, and it's cool.
Good for you. That's cool.
Yeah.
All right. Well, thanks for joining us for another edition of the Fundication Show. And Joseph, thank you so much for being our guest.
Absolutely. Thanks for having me.
Bye, everybody.
Thanks for tuning into this episode. If you are a passive investor and you're wondering where you can go to find great opportunities, head over to iShares website and look at our listing hub. Not only can you find fractional shares of existing real estate syndications, you could also find some of our approved sponsors and current offerings that they may have. Plus, we have the iShare Fund, which is a very diversified way to be invested in all kinds of different asset classes, sponsors, and geographies.